So let's get right to introducing our very special guest, Danielle DiMartino Booth. We're honored to have her join us for this Haymaker webinar. And if you don't know Danielle's background, she did actually work at the Dallas Fed back prior to the global financial crisis. And so she really was in the belly of the beast. And during that time, she very presciently warned about the disaster that was coming from the housing market and, of course, the very reckless mortgage lending of that time. And she was ignored, which is not unusual when it comes to the Fed and people trying to give them sage advice. So without any more ado, I'm going to just hand it over to Danielle. She's got some interesting slides for us to look at. And Danielle, it's all yours.
Well, first of all, thank you.
Danielle, sorry. I did want to mention, of course, your new career, which is as the author, the founder of Quill Intelligence, which is the visual that we see here, and that you're the author of the Daily Feather and then the Weekly Quill. And so she puts out some amazing content, actually quite a bit of content, and I read it diligently. It's a great service. So I just want to recommend that highly to everybody that's on this webinar. Sorry, it's all yours now.
Okay. You know what? I'm going to actually ask Adam if he wouldn't mind to pull up his slides. This is the second time in a row that my PowerPoint is freezing. So I'm not quite sure what's wrong with my PowerPoint.
Damn technology.
Hey, Mark, are you able to do that on your end?
Oh, wait, I take it back. Okay.
Oh,
now,
got it.
You got it.
I'm glad I'm not the only one who have trouble with these programs.
Well, I'm pretty good with these things.
I'm not.
And now it's freezing again. Okay, I'm sorry. I actually need your version of my PowerPoint. Sorry.
Okay, 1 second.
This must be Steve Cook telling me that I need to buy a new laptop. That's my running joke, is whenever things that start with an I or a Mac start to break, that's the kind of message that you need to go and invest in a new something.
They need all the help they can get sales wise. Not stock wise, but sales wise.
They need all the help they can get innovation wise. I say that in jest. But just to give you a feel for where I'm coming from, I have a much different view, and I have for some time, about the U.S. economy than most. So I'll tell you a little story. Years and years ago, when I was working at the Federal Reserve, and the beauty of working at the Fed, and I think the only thing that I miss about working at the Fed, probably, because I do not miss being a bureaucrat, but the one thing that I do miss about being at the Fed is that people spoke to you like you were a priest. Everybody would talk to you. So I was at Goldman Sachs. I had the full carpet laid out for me. I was visiting with their chief economist. This was probably 2006, 2007. And they had just hired this young economist by the name of Jan Hatzius. And he was brand new. He and I ended up doing a lot of work together on mortgage equity withdrawal, which was so much fun. It was Greenspan's body of work. I don't know if any of y'all remember the acronym MEW, M-E-W, mortgage equity withdrawal, when it was pumping so much money into the economy. But his boss at the time was a guy by the name of Ed McKelvey. And Ed McKelvey has a rule, just like the Somme rule. And that's my very first slide. Once we get that pulled up, I will share it. But his rule, unlike the Somme rule, says that you need a 0.3% increase in the unemployment rate off of its 12-month low to officially have entered recession. And in data back to 1968, the McKelvey rule has never failed. It has been absolutely flawless. So it was triggered in October of 2023. And at that point, I made the very, very out in left field call that the U.S. had entered recession, and that the National Bureau of Economic Research would eventually backdate recession to October 2023. And most of the world thought that I was stark, raving, lunatic, mad, crazy woman. And then, are we having trouble getting at my slides, maybe? There we are. So that first one, it shows you when the McKelvey rule was triggered every single time, starting in February of 1970 and going on down. In January of 2008, Ed McKelvey was interviewed by the Wall Street Journal. And of course, he's a sell-side economist. You're not allowed to say that you're in recession. It's like you can lose your job if you do things like that. It's just a no-no. In any event, the Wall Street Journal in January of 2008 interviewed him and said, it looks like we might be in recession according to your flawless track record. And he kind of hemmed and hawed, and he said, no, really, until the National Bureau of Economic Research makes that determination, I just don't think we can say one way or the other. But sure enough, the NBER went back and dated it in December 2007 when the McKelvey rule was triggered. And so this happened in October, and I said, gee, this is just, non-farm payrolls are so strong. And then a few months ago, we got the first quarterly census of employment and wages, QCEW. Nowhere in the history of the Federal Reserve have 4 letters been more important. We're going to know definitively what the birth-death model is for the 4th quarter in August of this year. But what we do know is that for the 3rd quarter of 2023, what the Bureau of Labor Statistics had reported using survey data is that they had announced 640,000 jobs had been created in the 3rd quarter of 2023. Now the census comes in, and by law, every employer must report their payrolls, their headcount, once a quarter to the census. And it takes the Bureau of Labor Statistics non-farm payrolls about 700,000 employers, I want to say, who are surveyed, and their response rate post-COVID has crashed to south of 40%. So there's a lot of imputing going on with the birth-death model. In any event, when the quarterly census comes out, that data is matched against what the Bureau of Labor Statistics has reported. So instead of the 640,000 jobs created, we actually lost 192,000 jobs in the 3rd quarter of 2023. So there's a chance that they could backdate it beyond October 2023. I don't think that that's going to be the case because the McKelvey rule was not triggered before then. But we do know that job losses on a net basis began in the 3rd quarter of 2023 from what we've learned from the state of California. And they reported this last week. I believe for the full year 2023, calendar year 2023, they created 7,000 jobs, and they did revise into the negative their 4th quarter numbers as well. Right now, 20% of unemployed Americans live in California, and California represents 11% of the nation's population. So almost double what their footprint is population-wise. So you could say that right now, ground zero for the U.S. recession is California. And of course, in November 2022, what was the employer? Amazon. They announced 10,000 headcount reduction in middle management, headquarters, and technology positions. That continued. The white collar recession continued, and really has been centered in Silicon Valley since then. And we know from this year that the layoffs in Silicon Valley have continued. Bear in mind, if there's one thing people ask me, Danielle, what's the difference between 2023 and 2024? My stock answer is speed. Last year, everything was happening at such a glacial pace. The unemployment rate was ticking up, but by half of a tenth of a percentage point, just glacial, slow. And a lot of that had to do with the type of jobs that were being lost. So you were getting 6 or 9 months of severance pay at 60% of your former salary. So if you were making 6 figures at Google, you weren't really feeling it. It was kind of okay. And 2024, it's been a much different backdrop. We've seen a lot of stores liquidate. We've seen the bankruptcy cycle pick up steam. And now we're seeing lower income workers at the front lines of individuals losing their jobs. They're getting 60 to 90 days of severance if they're lucky. Unlike a week ago today, there was a logistics company that is to the east of Houston called in a town called Humble, Texas. And on Thursday afternoon, it was either by text or by email, 2,000 employees were told they weren't going to get paid on Friday and that they were closing. So they just went into full liquidation. This is a private equity owned firm that did that. But the difference between 2023 and 2024 is speed, because things are happening a lot faster this year. And I think that the Fed could potentially have a deflation issue on its hand here in about within a year, which is so far-fetched that most of you think I'm back to being the crazy lady. Let's jump to the next slide, please. One of the reasons I'm concerned about disinflation, right? Today, Truflation, TRU, which is a real-time gauge of inflation, dipped below 2% for the first time in months. So we're at 1.99%. Gauging prices on a real-time basis. One of the biggest drags on Truflation of late, which was introduced to me by a bunch of fixed income traders about 18 months ago, one of the biggest drags these days has been housing. So we're seeing rental inflation. Beware of what you read in the Wall Street Journal. Remember, Rupert Murdoch owns Realtor.com. The data that you're seeing is not very reliable, but I am watching personally MLS listings absolutely explode. These Airbnb jocks, these investors who bought thousands of homes, they are, I mean, David, you could probably educate us on what's happening in Palm Beach. That's one of the epicenters of people trying to list their homes as quickly as they possibly can. Phoenix is another area. Where I am in Dallas, it's just biblical what we're seeing. In any event, this slide that we're looking at here, you have to go back to October of 1990 to see people's expectations for their income growth in the next 12 months fall at the pace that it fell in June in the 3 months through June of 2024. So people's incomes are absolutely collapsing. We're seeing more multiple job holders in the United States than we've ever seen. People with full-time jobs and part-time jobs in the BLS data. And as a result, you're seeing outfits like Cox Automotive, that's never had a bad thing to say about car sales ever, say that it's that there's an uncertain future for car buying in the United States, and that it doesn't necessarily have to do with interest rates right now. It's just people are really starting to push back. Well, there's your buying conditions for autos, homes, and durable goods. That orange line you see has just come right back down. This is a nasty little triple dip that we're seeing. Let's jump to the next slide, please. This is what I was just talking about. Your traffic of prospective buyers has triple dipped down. Redfin's home price gauge on a month-over-month basis was up 0.26%, the lowest in years. And it looks like home prices are going to actually go into an outright decline here. We did hear from home builders yesterday that the inventory of new houses in the United States is the highest since the great financial crisis. They're sitting on more spec homes than they ever have. And I dare say that a lot of the homes that have not been started inside the new home inventory will not be, because builders don't know what to do with the inventory that they've got on their hands. In addition to, we've got 525,000 apartment units coming online this year, 500,000 apartment units coming online next year before we finally see a dip in 2026 in terms of new apartment supply. And then again, as I was mentioning, a lot of these Airbnb jocks cannot get the financing anymore that they need to keep all of their rentals in order, and people's wherewithal to spend money on $30,000 a week rentals just vanished. Let's hop to the next slide. I do a lot of work on commercial real estate. It's interesting right now. My son is doing a summer internship at CBRE. So I'm getting all kinds of fun data from him for a change, instead of me saying, hey, I'm your mom, edit this. But it's really quite remarkable to listen to what my son is saying on the ground in Austin, Texas, physically in office buildings, about how empty they are. The vacancy rates do not reflect the shadow inventory that is sitting out there. But when you think of commercial real estate, people always go back to the crisis. And when you're, after going through bank call sheets, what we know is that the current cycle's off to a worse start than the prior one. I wrote about this 2 weeks ago. This chart's from a weekly publication that I put out 2 weeks ago. So that purple line there tells you that non-performing loan volumes are increasing at a faster pace off of their lows than what started in 2006. So right now, banks are beginning to shrink their loan books on the commercial real estate side. If you follow the Fed's H8 at the end of every week that comes out at 4:30 Eastern on Fridays, you've seen commercial real estate loan volumes be very, very unchanged. They've been in a very tight range. I asked my buddy Bill Moreland, who works at Bank Reg Data, what's going on there, and he basically said, it's just like a revolving line of credit for a corporation, but these are commitments that have been made. And right now we've just come through the period where committed construction lines and what have you have been fully drawn down. Now we'll actually start to see contractions in the loan book. When you get into a non-performing loan cycle, it doesn't tend to stop until it's finished. And by the way, it's not at all affected by the Fed cutting rates. Right now, I think the only thing that could possibly stop the bleed in commercial real estate is something that we'll talk about at the very end, which is a way that the Federal Reserve is going to give banks the ability to at least find capital relief from their commercial real estate loan books. And so I think that that's the only way that we're going to get there right now. But this process is well underway. And we should see the FDIC increasingly attempting to broker bank marriages going forward. It's very difficult to do because they're sitting on losses on their treasuries and mortgage-backed securities portfolios. And we still don't have enough price transaction volume in commercial real estate to really know what those loan books need to be marked down to. We can hop to the next slide, please. So this is an interesting set of charts. I find it to be fascinating that Morgan Stanley never sees a reversion to the mean. They do in the case of retail, they do in the case of office. They do not see a reversion to the mean ever for industrial or multifamily commercial real estate prices. My only comment here is take a mental snapshot, because the idea that there's not reversion to the mean means that this time is different. Those are very dangerous words to use. In terms of what Fed policy has done, we've seen another round of the great financialization, if you will. You see that on a net basis, buybacks have been really the biggest source of support for the stock market, followed by exchange traded funds. A note on ETFs is that when you add up the early retirees, we had a huge burst of early retirements at the end of 2023, the largest one that we'd seen since the pandemic first hit. So we had another huge burst at the end of 2023 because baby boomers' stock market portfolios are at record levels, their home values are at record levels. So we had a huge exit from the labor force. At the same time, the class of 2023, the class of 2024, they're not securing jobs and opening 401ks at the same pace that they had been in prior years. And on top of that, you have the white collar layoffs going on. So we saw a hard stop in January and February of 2024 of net redemptions from Vanguard's total stock fund ETF. So in data as far back as the fund exists, you have never seen 2 months in a row, January and February, of net redemptions from that fund. If there's one thing that can stop the momentum in the stock market, of course, stocks do not tend to fall until the Fed actually lowers rates. So this should not end until the Fed actually lowers interest rates. If you look back cycle after cycle after cycle, the stock market will hang in there until the Fed actually pulls the trigger. But it's fascinating to see that in indexing, we've seen the first turn ever. And you have to say to yourself, where are we going to see tremendous amounts of white collar job creation when last week the Richmond Fed Duke University CFO survey showed that 85% of the largest companies in the country are replacing white collar positions with artificial intelligence right now. So we're in that kind of chapter of AI before AI becomes more of a virtuous, has more of a virtuous effect on economic growth in the aggregate going forward. And I think it will. I think AI can do fabulous things for healthcare, for education. I think the applications are going to be tremendous. But right now, AI is being used as a cost-cutting measure. If we can jump to the next slide. This just came out in one of our dailies. Bankers had been a little bit more sanguine. They'd seen a leveling off in that green line of non-performing loans, and then we've just kicked back up. And so they're seeing loan demand turn back down, and they're seeing banking conditions, the wherewithal, tighten lending standards, what have you, look like they're going to turn back down. The Dallas Fed banking survey precedes usually the release of the Federal Reserve's National Senior Loan Officer Opinion Survey, the SLOOS, but it does have a very tight correlation with it. So it looks like we're about to go back into more credit crunch, a more apparently credit crunch type of environment, which is indeed what we're seeing with the bankruptcy cycle picking back up. Highly unusual to see West Texas Intermediate crude oil prices where they are, and Texas war notices rising as fast as they are. So
Danielle, for our viewers' edification, you might explain what a WARN notice is.
So if you're going to lay off a certain number of employees, you have to file a WARN notice with the state and assure them that you're going to provide adequate severance, 60 to 90 days, depending on what that state is. Right now, the three largest sources of WARN notices are the states of California. I have a different slide that I'm not showing you, but California, Texas, and Illinois. So you've got WARN notices in those states that are simply spiking. So we know that this steady drumbeat of increases, right? We saw continuing claims this morning hit the highest level since 2021. We know that the trend in jobless claims is going to continue because that's what WARN notices tell us. They warn us that in 60 to 90 days, there's going to be an influx of initial jobless claims. And that's indeed exactly what we're seeing, right? We've seen the four-week moving average of initial jobless claims just steadily rise, week after week after week, as opposed to coming back down to that 212,000 level. Now we're closer to 240,000. Let's jump to the next one, please. So this gets to, so we're just about at the end of my slides. This gets to the heart of what my biggest body of work is right now, which is Jerome Hayden Powell. At the end of his name, it says, comma, Esquire. He's not a PhD in economics. He's very familiar with my work, and he knows the Bureau of Labor Statistics is fabricating data. He actually said it at the podium that payrolls were overstated this last press conference. He knows that he's going to have a disinflationary, deflationary problem on his hands. He can very well see inside the national debt with his own two eyes that right now, at the margin, federal spending is not growing. The cost of service interest is growing, but on a net basis, we're not spending anything more on a federal level. There will not be any stimulus checks sent to Americans until April of 2025 at the earliest. So the next fiscal relief we're going to see on a federal level will come with the income tax refund season. So starting, call that February 1, 2025, that's the first cash that households are going to be receiving. And then it really depends on the makeup of the Senate, right? Donald Trump wanted a $2,000 check in December of 2020. A GOP-led Senate said no, they cut the level of that check from $2,000 to $600. Of course, Biden got that $1,400 balance day one in office. That was not delivered to households until April of 2021. So I'm just saying April of 2025 is the quickest we're going to see a stimulus check cut, with Manchin's Senate seat looking like it's going to go red. If we go back to having a Republican majority in the Senate, I think it's going to be that much more difficult to pass large stimulus measures, depending on how apparent and obvious and painful the recession is by then for whoever in Congress is already going to be looking at midterm elections in terms of the wherewithal to pass federal stimulus measures. In the meantime, then why is Jay Powell not lowering interest rates? Why is he knowingly committing a policy error if he knows that the state of California has shown that what happened in the fourth quarter were net job losses? You know, what happens in California is a pretty good barometer for the nation as a whole, given it's the world's fifth largest economy. So then why is Jay Powell refusing to lower interest rates? Why does he say that the economy is strong? Why does he maintain that the consumer is strong, even though their expectations for their income growth have absolutely collapsed? Why, Danielle? I'm asked all of the time in my capacity as a Fed whisperer. Well, this is why. This is why. It's because the non-banking financial sector's $240 trillion globally. That is a big number. The conventional banking system is 183 trillion globally. So the unregulated shadow banking system, if you will, is larger than that which is regulated. And in fact, they've fed on each other in recent years. Maybe I've got that on the next slide. Yes, I do. The growth of the non-banking sector has been fed by the conventional banking sector, because it's the conventional banking sector that funds private equity, private capital, private, you name it. They get their funding from the banks. So banks may not hold corporate debt on their balance sheet anymore because it's on a regulatory level, it's very expensive to do so. But they've simply become the banker for the non-banks that now hold that credit risk. So I'm happy to send, David, as a courtesy, I'm happy to send anybody a PDF of the full write-up of the symbiosis, the fact that the non-banking sector has fed off of the banking sector. And this goes back to Jay Powell. If he can press forward with Basel III endgame, then it will become a lot more expensive for the non-banking sector to exist. They'll have to have more skin in the game. They'll have to, we've already passed central clearing of treasuries. So that will go into effect by the end of this year. So regulators are going to get to see, gee, that's Ken Griffin. Gee, that's Steve Cohen. I know who's behind these massive levered treasury plays. But as you can see, in the post-pandemic era, the correlation between the banks and the non-banks has actually increased. And why is that? In a nutshell, non-banks are also too big to fail by virtue of the fact that the banks are financing them. So there is an interdependence that has grown between the conventional banking sector and the non-banking sector. And if Powell wants to get his name put on the outside of the building, and they're going to change it from the Eccles building to the Powell's building, then he presses forward with Basel III endgames, and you actually bring out of the shadows the rainmakers, who in a post-Dodd-Frank world bled out of the conventional banking system because they really didn't want to have anything to do with the Volcker rule. So they just left. But the same exact forms of banking have been perfectly feasible. Securitization markets, as we know, have absolutely exploded. But in a post-Basel III world, which could be just about in place by May of 2026, when Jay Powell's term's up, and when Michael Barr leaves when his term as vice chair of banking supervision regulation, that's up in July of 2026. We could have it in place by then and finally have the beginnings of regulation of the non-banks, which would be genuinely a sea change in the financial system, in the world of investing as we know it today. A true revolution. And I think that that is why Powell is doing what he's doing. He knows that the Fed's footprint in the mortgage-backed securities market needs to disappear. That's why he said that quantitative tightening is going to continue on the mortgage-backed securities side, even if and when they completely cease to roll treasuries off of the Fed's balance sheet. They know that they need to get out of the credit easing game. The neutral Fed funds rate has crept up to 3%. Why is that? They know that zero interest rate policy fed the the growth of the non-banking financial system, and that zero interest rate policy thereby cannot be revisited. So these are gigantic, huge, biblical changes that we're talking about here. And I'm no shill for the Federal Reserve. I wrote a book called Fed Up. Hello. You know, why the Federal Reserve is bad for America. I'm not some Fed shill, but I do applaud Powell and Barr's efforts to try and begin to rein in the cowboys of finance who regularly pay themselves billions of dollars. And for what? You know, the beta, the extra return that you get has simply disappeared in recent years. And now we know from the REITs where they've got gates up, you can't even get out as an investor. So somebody needs to rein in the shadow banks. And I hope that Basel III Endgame allows Powell to do that and that he has enough time in office to do that. By the way, the Supreme Court has ruled in the past that Trump cannot fire him. That's the first question I get from everybody. I believe it was Garfield who was in office at the time posthumously. They reinstated the head of a federal agency who was politically discharged. And given that Supreme Court precedent, the members of the Federal Reserve Board could vote to keep Jay Powell in office, even if Trump tries to fire him. There's one more slide. I really cannot remember what it was. Yes. Is this a title fight that Jerome Hayden Powell wants to win? So as of July the 1st, we'll be 12 months in from when the Fed last moved. When we waited 15 months before, it was no bueno. The ending was not pretty, but that gives you a feel for how very long we have had this higher for longer regime in place, when most people thought that the first time Blackstone's REIT threw a gate up, that would be enough to make Powell blink and go back to the zero bound and start blowing up the Fed's balance sheet all over again. And he has held firm. So go figure. And with that, David, I have no idea how long I've spoken. Oh, yes. Oh, sorry. This is an important one. So this gives you a feel. So what this is from the time that I believe it was payroll, from the time that the unemployment rate was a certain percentage point off of its lows, which was, I think, triggered in April. This is your average in any given cycle percentage yield decline and percentage S&P decline. Again, on average, call it from April of 2024 to whenever the correction ends. You'll see a 32% drawdown in the S&P 500, and on average, you'll see your 10-year nominal rate come down by about 1.5 percentage points, 23.7% on a percentage basis. But this is just looking back one cycle, going back to the 50s. So, and again, I'm David, I'm happy to share these slides as well. If anybody's
Thank you, Danielle.
in seeing.
And that's actually a great visual. That's your final, right?
That is, yes.
Do you mind going back to that one, please? And I just want, because I think what you talked about this before you even got to the slide, which I think is so critical. You said earlier that when the economy starts going down is when the Fed actually cuts rates. And also, as we should know, but Wall Street seems to ignore this constantly, is when the Fed cuts, especially when the Fed cuts a lot, it's actually stock market bearish. And yet you've got most of Wall Street very excited about the prospect of a Fed rate cutting cycle. And as I've commented in the past and written in the past, when you get one or two cuts if it's truly a soft landing, which is very rare, but if it is, that can be indeed quite bullish for the stock market. But as this indicates, when you get into a really serious interest rate declining phase, and typically that's because the Fed has been tight too long, and your prior slide was discussing that. And I think related to this, Danielle, correct me if I'm wrong, this has been the longest yield curve inversion we've ever had. So where short rates are higher than long rates. Is that
In
the
history.
case?
Yes, it is. It is the longest one in history. My gallows humor, Dave, is that, somebody in the stock pits on a trading floor is like, wait, the Fed just cut rates. Somebody pull up ECO Go on Bloomberg. Let me look at the macro, what's happening. And that's when they actually stop and look at macro data and go, oh my God, we're in recession. And the Fed actually acknowledged that we're in recession. Sell, sell, sell. And that's typically how these things go, but they do not happen until the Fed actually lowers rates.
So that's hugely important. Thank you for having those visuals in there. So I don't want to dominate this because we only have a few minutes left with Danielle. So anybody that would like to ask your questions, please don't be shy.
I think that might be shell shock, David.
I think Mr. Harbaugh has a question, I would imagine.
I think there's some in the
I always have a question.
chat. Yes.
Hi, thank you for doing this. So you talked about symbiosis between conventional banks and non-banks.
Mhm.
The money goes from the banks to the non-banks to whoever they lend it to, or for whatever asset they buy. Now those assets are maybe not as worth as much as they used to be, and there, as you say, some problems with investors being gated and not getting their money back. I saw that Harvard had to borrow money to pay its operating expenses because it was a bit too tied up in some of the private equity stuff. So I'm wondering, there's all these contracts between them, and when things get ugly between the banks and the non-banks, how's that going to go? Who's going to end up taking the loss, especially if some of these contractual documents don't have a lot of substance to them?
So you bring up probably the most important point, and that is that the banks have assumed the liquidity risk. They've absorbed the liquidity risk of the non-banks by virtue of doing business with them, by virtue of being their prime brokers. It's no longer counterparty risk per se, because they're not facing the counterparty anymore as they once were to the same extent, but they have the liquidity risk of the non-banks. That's what they've assumed. So that can turn into an adverse feedback loop where all of a sudden you are in a liquidity vacuum. And what that does to valuations, what that does to unrealized losses is anyone's guess because of the magnitude of the growth in these areas, right? I mean, we are what we finance. So much of the economy now keys off of the financialization of America, right? The biggest buyers of stocks have been corporations. They're not running companies, they're running banks. So I mean, if I could answer your question, I could probably retire yesterday. I don't
hoping
know.
you'd help me do that.
Yeah, no, I don't know, but what I can say is that on days that we've seen trading seize up, and you see and this was right after the pandemic hit, when we were seeing fallen angels and the rating agencies downgrading companies left and right at that time. And when high yield was gapping down 50, 60 cents on the dollar, what we were hearing on the private side was more like 20 cents on the dollar. So the gap between valuations is just a gigantic unknown because private equity firms have been trading portfolio companies back and forth with one another for years at increasingly higher valuations. Not that they've added any value to the business model, but it's just been this great big fun game for GPs to play amongst themselves. And we've just sat by and let it happen. They're not regulated. So
Of course, that's what Jay Powell used to do for a living, right? When he was at Carlisle.
He did. He founded the Industrials Group. Jay Powell knows exactly what's going on. I mean, Jay Powell said out loud in October 2012, when he was a rookie on the Federal Reserve Board, you know, when and if we ever try to extricate ourselves from this quantitative easing strategy, we could have a full-blown duration bubble explode across the credit spectrum. His words, not mine. So he gets it. What? I think.
So sorry about that. We've only got a couple of minutes left before I have to let you go, and we've got a bunch of questions that have come in here. So
And
I think
please
one
send me any questions, David, I have not answered, and I will happily put them in an email.
Oh, that's great. So everybody listening up to that, send us emails and we'll forward them to Danielle. But one that came in that because I think some of these I can answer once you leave, but there was one about given your outlook, how would you invest? And I think bonds would be longer bonds, extended duration would be part of that answer. But what else would you play with in this very hazardous environment?
It is a hazardous environment, David. And you're still getting paid to be a spectator handsomely. I mean, my 4 teenagers don't know what to do. I'm like, I told you compounded interest was not a myth. I've sworn a stack of Bibles it was a real thing. But I mean, I think in these kinds of environments, the biggest risk you have is correlation. And so it's very hard to find asset classes that are not going to completely align with each other correlation wise. And so I would, you know, as long as you are absolutely positive that the dividend's not going to get cut. I mean, I own a Brazilian agriculture company that every Brazilian widow owns with like a 9% yield. I just happen to know that the Brazilian government's going to take care of it, knock on wood. So, but it's a dividend. It is a dividend lockup. But, you know, industrial properties, you know, data centers, everybody's looking at the same exact areas right now to invest in because they're what the future is going to be. Well, what does that tell you? Remember, Cisco Systems was very profitable and had extremely strong sales years after its stock price imploded. It was not a badly performing company in the slightest sense of the word. It was a magnificent business model, strong company, strong revenue growth.
As was Microsoft, but Microsoft still traded down to 10 times earnings. So it just shows what can happen when you get into a much different environment. We're right there, Danielle, and I want to make sure that you get to your next event on time. So thank you so much. And it's really nice of you to offer to answer any email questions because I'm sure we'll have quite a few of those, maybe even some from me.
I'm happy to. And if anybody wants to, I mean, you can attest to the quality of the research. If anybody wants to go on trial for pro, just reach out. I'm happy to pop you on for a month and let you see the work that we crank out 8 times a week.
That's a big offer, a very generous offer. So you guys and ladies listening in here, I would take advantage of that. Okay, Danielle, thank you again. Have a great weekend and a 4th. Enjoy your 4th.
Oh, thank you. Happy 4th.
Try to stay cool. Try to stay cool down there in scorching Texas.
For the 4th.
Oh, there you go. Okay, that should be a little.
Dallas. It's about 1,000 degrees outside.
Little less. Yeah, right. Okay. Enjoy. And say hi to your family for me, including John.
Take care, everybody.
All right, team, feel free. I know there's a bunch of questions and I'll do my best. I'm not Danielle DiMartino Booth, but I'll do my best to answer them. So let's let Danielle go and then I'll take it from there. Sorry, you got to deal with the second string here, everybody. Mark, are you able to
see the questions in the chat, or do you want me to read them?
Go. I saw some of them come through earlier. I know somebody was asking about Jay Powell and if he's worried about the gamification of the financial system. So I guess I could address that one. As she said, Jay Powell came out of the private equity business. He was at Carlyle. I think Rexnord was his crown jewel. And there's a great book out there, Chris Leonard. Mark, you might help me with this. I'm trying to remember the exact title, but it was basically about his career in private equity. And it wasn't really that complimentary, frankly. I mean, it really does point out what these private equity firms do to great American companies and how much they leverage them up and then the layoffs that can happen. Mark, what was the name of that book? Chris Leonard's book was about the Fed.
Yeah, yeah. Let me pull it up.
Anyway, while he's doing that, it's a really good read if you want to try to understand his mindset and what his training was, because unlike people such as Alan Greenspan and Janet Yellen and Ben Bernanke, he's not a PhD economist. He's a real world business person, and he really does understand that. And as Danielle said, when he first joined the Fed, he was warning his peers, but he was very junior at the time. What we're doing here with these serial QEs, when it was just money for nothing year after year after year, was that there was going to be hell to pay at some point. Then once he became part of the inner circle, of course, his attitude changed drastically, and he became much more of an apologist for the Fed's activities. But I think he's very worried about what's happening. I think that may be one reason why he's maintaining interest rates as high as he is when he sees the kind of speculation that's going on in the market. And you don't have to go any further in terms of gamification to look at these meme stocks like GameStop and to see that's happening, or with the cryptos. And I'm not talking about Bitcoin because I know that's got a great bull story, but the rest of the crypto space that's almost totally worthless. And then with even SPACs making a comeback. So it's almost like we're doing a flashback to 2021 with this really wild speculation. And that ended very horribly for the people that played that game.
David, it's a January of 2022 publication, The Lords of Easy Money.
There you go.
How
It
the
was
Federal Reserve
Christopher Leonard, wasn't it?
Yeah, Chris Leonard, and the subtitle was How the Federal Reserve Broke the American Economy.
That's really right up my alley. I think you guys know my book was Bubble 3.0, Who Blew It, and How to Protect Yourself When It Blows Apart. And the perp in that book was, of course, the Federal Reserve. And I'm kind of in the camp with David Stockman that we either need to drastically curtail their activities or simply abolish them. They're really they've created tremendous problems for this country, in my view, and in his. Okay, what else do we have?
From the chat, greater likelihood, deflation, disinflation, or inflation.
Well, I'm answering for Danielle, which is a little bit dangerous, but I think she would say disinflation. She did kind of touch on that in her remarks, and deflation already happening, certainly in real estate. And I think we're going to probably see more deflation in real estate until this cycle really plays itself out. And whether that will trigger a great financial crisis type of thing, or global financial crisis, great recession, and then that triggers all these financial meltdowns. I mean, we started to get that last year, obviously, with the three big bank failures, and then the Fed came in with their bank term funding program, and they were able to stop it, kind of firewall it. So I do think that this is where maybe she and I diverge a little bit longer term, is I think that because the powers that be, basically monetary, the Fed, fiscal, the Treasury, are so concerned about avoiding an asset price meltdown that they will resort to extreme measures to keep this whole crazy train that we have on the tracks. And that might involve very inflationary responses to what should be a recession that would lead to disinflation / deflation. So I do know that she said that should Donald Trump win, she is going to become very concerned about bonds, because he clearly wants to cut taxes. He has no concern about the federal budget. I don't think, frankly, the current administration has much concern about it either, based on their activities. If you don't know this, the CBO, Congressional Budget Office, just raised the federal deficit from 1.6 trillion that they were expecting previously to 2 trillion, $400 billion increase. And so we're back to running these $2 trillion deficits, 7% plus of GDP, in what is at this point still a decent economy. And that's just, that's already so problematic for the bond market in terms of all that issuance that has to occur to be able to fund that deficit. And if if the deficit blows out further, let's say Donald Trump gets in there and does a big tax cut again, I do think the bond market is going to be our reality check and break on these just crazy policies that we've been pursuing. All right, I hope that answers a little bit.
There was just one in here. Oh, is private equity, i.e. TPG, a short candidate?
Well, I know she believes there's going to be all kinds of problems with private equity, and we're already starting to see that spill over even to private credit. So the equity is the more aggressive, that's where you get the high returns, but you take the greatest amount of risk. Private credit is more insulated because the equity people get wiped out first, and there's usually tranches or levels of private credit. So you have the more aggressive mezzanine equity tranche. This gets all back to what happened with subprime mortgages and CDOs 16, 17 years ago. So it's it's sliced and diced. The idea is to try to protect the highest level of the private credit tranches or investors. But it does. I mean, there was one here recently that was a private equity deal that is falling apart, and it's negatively impacting the loan value on the private credit side, and it's from a very prestigious firm, Vista. So there are flaws already starting, or chinks in the armor starting to appear. And I do think that as things get tougher, we're going to see a pretty good shakeout there. And that's not to say that you should get out of private credit. I think private credit makes sense if you're with the stronger firms, but I think there's going to be a lot of problems at the equity level. So yeah, and I know she believes that's why she was talking about this shadow banking system and how it's going to bleed back into the banking system. It reminds me a little bit, and listening to her talk, I was thinking back to when back in 06, 07, and there was a pervasive belief at that time that the big banks were fine because they had been packaging up their mortgages and selling them off, theoretically to hedge funds and other participants in the shadow banking system. The problem was the investment departments of those banks were buying that stuff. So it just recycled right back onto their balance sheets, which is why they got in so much trouble, when these things started to blow apart. So I just think that when you've had such a long time of suppressed interest rates and excess liquidity, people get sloppy. And there's a lot of excesses that do build up in the system. And then when you finally do get to a point where asset prices start falling and animal spirits go from very risk accepting to risk avoiding, that's when you can have things decelerate or deteriorate very quickly. Do we have any others?
Next one is on the path of dollar versus gold in the context of the discussion. And do you see gold as a useful counterbalance in a portfolio?
Well, anybody that knows me knows that I've been a gold bull, and I still am. It's been doing pretty nicely for the last couple of years, but it's not straight up. It goes up and comes back, and goes up and comes back, and it's been fairly non-volatile compared to a lot of the other commodities where you've seen big run-ups and then big declines, and things like palladium and platinum and copper, which hit a new high here recently that's just been slammed. And so gold has been kind of the steady eddy, but it's partially because it's not just a pure commodity. In fact, I think most experts would say that it's more of a alternate reserve currency than it is a speculative commodity. And I think that's probably true. I think everybody knows, but I'll just restate it to make sure. This foreign central banks have been huge buyers of gold in recent years. I think that's one reason why there's been such a disconnect between the price of gold that's been kind of steadily going up and the gold miners, which have been dogs until lately, because the central banks don't buy U.S. or North American mining stocks. But I do think gold has a very important role to play in terms of being kind of the ultimate anti-fragile asset. I mean, that was the idea with bonds for so long, is that if you had a bad stock market, bonds would go up in price and down in yield, and that would give you protection from the bear market in stocks. That did not at all happen in 2022, which actually was one of the anticipations in my book that was published in early 2022, is that balanced investors would lose on both parts of their portfolio. Now, obviously, since 2023, stocks have been in a tremendous rally mode, at least led by the mostly big cap tech stocks or mega cap tech stocks. Most of the rest of the market, frankly, has been struggling. It's recovered a bit from the 2022 thumping, but not a lot. It's a very, as she used the term bifurcated, describing the economy. There's so much bifurcation around. I think that's kind of the ultimate forcing out there right now, is this tremendous gap between things or entities or parts of the market or consumers that are doing very well and those that are really struggling. I think you're starting to see more and more struggling going on. And just looking at the stock market here recently, there have been some really poorly received earnings announcements, including from the home builders that she was talking about. And I don't know if anybody wants to ask me again about the home builders, but I think we're getting an emperor has no clothes kind of moment with the home builders. So I think gold definitely has an important role to play. And I just would say be careful when it runs up and be willing to buy it on weakness, because you typically get a sell-off when it has a big move, even with great fundamentals, which I think it has. Thank you.
Last one in here is historically have the bluest of blue chips also significantly declined after rates decline 150 bips as per your last slide, the slide from the deck.
I just happened to read a research paper on that recently saying, yes, be careful in thinking that if you go into high dividend, basically the dividend aristocrat type of stocks, that you're going to be insulated from a bear market. And I think that's good advice. I mean, they typically go down less, though, you could say that, well, they should benefit because interest rates coming down makes their dividends look more attractive. And that's probably why they do hold up better. Typically, their business models are also less cyclical to be in that dividend aristocrat category. So I think that also helps them. She was talking about like a Brazilian food company that apparently they never cut their dividend. And yeah, I think that makes sense. If you're going to be in equities, it probably is logical to be doing some rotating from the NVIDIA type names, which actually I did recommend taking some profits, as some of you saw, and kind of got lucky with the timing on that, although I know it's bounced back a bit. But it kind of looks like maybe it's hit its high point here at over $3 trillion. So I think it does make sense to be taking a bit off the table with some of these very aggressive stocks that have had tremendous appreciation and recycling that back into companies that are more reasonably priced and have, in many cases, pretty, 3 to 4% types of dividends. I continue to think midstream energy. So we used to call these MLPs, the pipelines. They look pretty good with, the premier one is Enterprise, and it's, these aren't dirt cheap like they were for so long, but it yields 7% and it raises its dividend every quarter. So, and it raises its dividend or distribution at a rate greater than inflation. So if you're collecting a 7% distribution from it, which it's paying right now, you're actually getting that net of inflation. Usually, I know I've said this before, but I'll reiterate, it's such an important point. Usually if you get a bond that's paying you, say, 5% and inflation's 3%, you're really getting a net return after inflation of 2%. But if you're getting 7% from an entity that's raising its distribution, at least at the inflation rate, you are really getting that 7% return. And I think most people still don't, frankly, give a darn about the midstream space. So there's still some interesting opportunities there. Looks like we had another one.
One more came in regarding, do you have any theory why all the gains in S&P have occurred in the overnight session with daytime gains closer to flat? Is there a vulnerability there? And then he goes on to say, presuming it's international companies buying, but what happens if they ever lose that appetite and want to reduce?
Yeah, that's an interesting point. Probably true, because I do know that a lot of these offshore entities, even central banks, one of the largest holders of U.S. equities is the Swiss National Bank, basically their Fed. And I think the Bank of Japan, but certainly a lot of Japanese institutional investors have been buying U.S. stocks. So that, I think, is a logical explanation of why that tends to be the case. Interestingly, another similar factoid is that if you look at the S&P outside of periods right around Fed meetings, and that's regardless of whether they raise or lower interest rates, if you back those times out, the market's gone nowhere for decades. I haven't seen that updated lately, so don't hold me to it absolutely, but I have a feeling it's still probably true. So yeah, I mean, all that stuff just makes it feel a little bit artificial. Maybe, certainly from what I just cited, way too much driven by the Fed. And that's why I wanted to bring up this point, and I'm so glad she had that as her last visual, is that there is this absolute conviction on Wall Street, and you see it all the time. If we get into a Fed cutting cycle, that's really bullish, and it's not. I mean, just look back at 2000 to 2002. The Fed cut interest rates dramatically, drastically, one of their biggest interest rate cutting campaigns ever. And the market went down about 50%. Then if you look at 2007 to early 2009, again, massive interest rate cuts. They went from over 5% down to basically zero, and the stock market got once again cut in half. So I do think it's a case of be careful what you wish for. And it's also why this hard landing versus soft landing debate is so important. I mean, obviously, Danielle is really sticking her neck out there saying, we're going to have a recession. Very few people say that other than David Rosenberg. And I was going to bring up, and I didn't, I will with you all now, that, and I will email this to Danielle to get her take, because Luke Groman, who I respect very much, is out there saying there's no way you can have a recession when you have a $2 trillion federal deficit. And there's truth to that. Now, I think, reading Danielle as much as I have, I think what you would say, okay, but you can't just look at the level of the federal deficit. You have to look at the rate of change. And if the rate of change looked like it was going to be negative here for a while, but now with that increase that I talked about earlier, it looks like the rate of change is going to be flat. Whereas last year it went up 100%. So you literally went from $1 trillion to $2 trillion with proper accounting in the federal deficit last year. So that was enormously stimulative. So she's got a point, and it's going to be interesting how this plays out. I don't know that we ever had, usually when you go into a recession, federal deficits are pretty low. I mean, they're not usually in surplus. They were at the end of the 90s, but typically they just go down a lot, but to a small deficit. In this case, we've got this monster deficit going into a recession at some point. It's unprecedented. So it's going to be really interesting to see how this plays out.
For an international investor who invests in US stocks by converting their local currency to US dollars, what are the risks associated with depreciating US dollar, even if US stock prices increase?
Yes, I think it is a definite risk. I think it's more of a risk for those countries where their currencies are deeply undervalued. I mean, I've been so wrong about the yen, for example, thinking that it would bottom out, at 150-ish, it's 160. So it takes 160 yen to buy $1. That means it's going down when that number is going up. It's getting cheaper and cheaper in US dollar terms. But if I'm a Japanese investor, I'm holding US stocks or US bonds, and I think my currency is fantastically undervalued. At some point, I'm going to think I want to go home. I want to take my money back to Japan, and especially since their stock market's been, in a breakout mode. It's, it was a terrible market for 30 years, and now it's in a very powerful uptrend. Or, put it back into Japanese government bonds. A lot of people don't realize that they only look at the 10-year Japanese government bond, which is very controlled by the Bank of Japan. They do have yield curve control there, but the 20 and 30-year maturities are not controlled by the Bank of Japan, and you can get 2%, which in Japan is a big interest rate. So there, will money go back to Japan at some point? Because they are, unlike America, I think they're the world's largest creditor country. We're the world's largest debtor country. If they're not the top creditor country, they're very close to it. So they have vast overseas investments, and if there's ever a repatriation back to Japan, man, that has the potential to be really destabilizing. I don't want to be gloomy and doomy because I think there's parts of the U.S. stock market that I was kind of mentioning earlier that look attractive, but I just think there's much too much optimism and complacency out there right now. One other way to look at the VIX. The VIX, the volatility index, is very suppressed, and you have, once again, you would think these people would learn their lesson just with the meme stocks, where they're playing these VIX ETFs, where they collect this option premium it's an option premium on the VIX, and it's just like found money. It's just a cash machine. The problem is that when the market goes down sharply, they get crushed because the VIX goes straight up. And if you go back to 2018, when we had the so-called Volmageddon event, most of those ETFs went down 98% and were shut down. So I think these people that are playing that game are going to get nuked again. It's just a question of when.
Well, that's it for the chat. So I think we could probably wrap it up.
Great, everybody. So I would take advantage of Danielle's offer, both to email her questions, and actually I'll send her that email that I mentioned about Luke Groman, and you can't have a recession with $2 trillion deficits. I'll share the answer with you through one of our Haymaker postings, and I would take advantage of her offer to get a trial subscription. It's good stuff. Thank you, and again, a happy 4th to everybody. We'll see you next month.